Learn exactly what lenders review: credit, cash flow, collateral, and business plans, so you can qualify for funding with confidence. Getting approved for business financing isn't about luck, it's about knowing what lenders actually evaluate and preparing the right way. In this webinar, we will break down the real decision-making process lenders use when reviewing loan applications, including banks, online lenders, microlenders, and SBA programs. Ladies and gentlemen, my name is Noel A. Booker Sr. with businesscreditbuilder.us. And at businesscreditbuilder.us, what we do is help businesses build business credit and access funding. Okay, I'm switching my thing over here to so you can see my program on the screen here. Okay, all right. Okay, now you should be able to see everything much better. There we go. Okay, what lenders look at to approve you for financing? My name is Noel A. Booker Sr. Here's my contact information. Notice that there are three buttons at the bottom. How to get a free guide on how to build business credit. Just go to businesscreditbuilder.us/free guide. If you want to talk to us about the services that we provide, schedule a free business credit consultation at businesscreditbuilder.us/consult. And if you think you're qualified, you can qualify for funding now. Go to businesscreditbuilder.us/get funding. Okay, business financing. That's what we're going to talk about today. It could be a challenge, particularly for some startup companies. Lenders tend to be cautious. They want to be sure you'll pay them back. There are several options. These include traditional lenders, usually banks, online lenders, micro lenders, and the infamous SBA, right? Okay, what do loan applicants need to supply? Lenders generally want to see that you have enough assets, sufficient financial reserves, and enough personal collateral to ride out business fluctuations. How do loan applicants demonstrate these things? The borrowers need to show a solid cash flow sufficient to repay the loan. They need to show a track record of profitability, and they have to demonstrate success in a similar business endeavor. Essentially, they have to prove their credit worthiness. This isn't easy when you're just starting out. For startup entrepreneurs in particular, they will need to demonstrate by using other means that they are credit worthy, that they are a credit worthy business owners. One way is to prove that they owned or managed a profitable business in a different industry. This means bringing in a resume and maybe financials from an earlier venture. They may be able to show this if they can supplement their own experience with that of someone who also has success in the business. This means bringing in a partner or maybe an angel investor as a mentor. Preparing to meet with a lender. The borrower should have the following items: a sound business plan, any financial information that they can provide on their business, information on their personal credit, often also some means of securing the loan. Okay. And that goes back into what I always talk about, the three C's of credit, right? Cash flow, credit, and collateral. These are the three C's of lending that every lender will definitely look at, right? So one thing I like to say is this, right? The three C's of lending, right? Credit, cash flow, collateral, right? Now, if you have all three of these, then you could possibly qualify for an SBA loan. Now, an SBA loan is the best place you could get a loan because they give you a lot of money, low interest, and they span you over time, right? So, but a lot of people can't qualify for these, right? So, if you have two of these three C's, then you could possibly qualify for a term loan. If you have one of the three C's, depending on which one of the three C's you have, there's money available for you right now. Now, if you have none of the three C's, then that's when you start with business credit. And business credit is like it's like letting them know that your business can pay a bill on time. And they definitely going to look at your business credit. If a business is looking for a loan, they're going to look at your business credit and see if this business, not the person, this business pays bills on time. And they need to see something, right? Okay. And when you do have business credit, how it helps you is that it can mean that you do get approved or you don't. It could mean the difference between what the terms are of your loan based on what your business credit is. Okay. Okay. Okay, we're gonna continue on to the next slide. What goes into a sound traditional business plan? Industries vary, but traditional business plans all have similar components. These are an executive summary, description of the company, and a market analysis. Okay. Business plans also include data on the company's organization and management, a description of the service or product line, marketing and sales data. Startups won't have much in this way of sales data, but they should have a handle on how they're going to market their wares. Okay. Business plans also include the company's actual funding requests, financial projections, and appendix, which includes all supporting documentation. These are usually shorter than traditional plans. They include information on key partnerships, activities, and resources, the value proposition, customer relationships, and segments. Okay? They also include communications channels, cost structure, revenue streams. Parts of a traditional business plan. Executive summary, which is a brief overview of your company, product, executive team, and future plans for growth. Company description. Get into detail about your company's niche and the problems it solves. A market analysis. How can you do better than your competition? Okay, so you have to know what's going on within your industry, right? You have to know what's going on outside of your own world. Parts of the traditional business plan, um, company organization and management. What's your business entity and who does what? Service or product line. Not only what you sell, but also future plans or even patents. Marketing and sales data. What are your strategies to attract and retain customers? The company's actual funding requests. Itemize and clearly show how you were looking to spend the funds. And that's real key right there. How you are looking to spend the funds. Okay? Because in funding your business, right, you have to figure out, well, what do I need to spend money on? Because, with business funding, there's all different programs for different types of situations, right? So knowing what you need to spend on, let me give an example. let's say you want to buy machinery or equipment for your business, right? Well, there are alternative lenders that only fund equipment, right? And vehicles are equipment, right? So, and if that's what you need for your business, now we can look at getting an equipment loan to finance your business. You see what I'm saying? Okay, financial projections include some income statements and the like, if the company is already established. If not, this is a place to list potential collateral. An appendix. Here's where to add licenses, ooh, excuse me, licenses, permits, and patents, and the like. Key partnerships with suppliers and manufacturers. Which suppliers and manufacturers will you work with? Key activities. How will your company gain a competitive edge, advantage? Key resources. Which resources will you leverage to give your customers value? This can include personnel, intellectual property, capital. Value proposition. Which unique value will your product or service bring to the market? Customer relationships. What will the customer experience be like? In person, online, or something else, right? So me personally, when I used to do a lot of events, right? And when I plan these events, and I bring this onto my business now, I plot out every single step that a potential customer will one be acknowledged who I am, right? How will they find out about me, and the steps that they will go through, right? So that's important, I believe. That's just me, right? Customer segments. Who will your business serve? Do you have a good handle on what your ideal customer is really like? Communications channels. How will you speak with your customers? How will you optimize communications in the future? Cost structure. Will you be trying to maximize value or reduce costs? Regardless of strategy, how much is that going to cost? Revenue streams. How will your venture actually make money? Direct sales, memberships, or subscriptions, selling ad space, or something else. Apart from the business plan and its contents, you will need a P&L, a profit and loss statement, right? So, like having these type of financials on deck lends credibility to your business, right? So like for the lenders that's gonna ask you for a profit and loss statement, you need to have them on deck, ready to be like, here, you need that? Boom. Not, all right, let me get it. It's gonna take me a couple days, right? So having this profit and loss statement and your balance sheet on deck at any given time lends credence to your fundability. Okay. A P&L is, according to Investopedia, a financial statement that summarizes the revenues, costs, and expenses incurred during a specific period of time, usually a fiscal quarter year. These records provide information about a company's ability or lack thereof to generate profit by increasing revenue, reducing costs, or both. The P&L statement is also referred to as a statement of profit and loss, income statement, statement of operations, statement of financial results, and income and expense statements. Basically, it's the P&L. Okay. Um, the P&L, one of the three quarterlies or an annual statements a company makes as to its financial health. So usually businesses do this monthly, some do it quarterly, and some do it yearly, right? The The other two are the cash flow statement, the balance sheet. There are numerous blank P&L forms online to help you. Okay? What does a P&L show? The idea is to show changes in accounts. This is over a specific time frame. In that way, it's similar to your cash flow statement. This is not like a balance sheet, which is more of a snapshot, a time and place. Okay. A P&L will give you a handle on the money your business has. You know how much capital is coming in and going out. It's good for more than just another piece of paper to give to a lender. Monthly and annual revenues. Online lenders in particular want this data. It shows not only what your company makes, but also any trends or even seasonalities. Okay? Bank balances. Online and offline lenders want this data. Like the cash flow lenders, they want to go into your bank account and they want to see the deposits you make, right? So my cash flow lenders, let's say of the three C's, your only C is that you got cash flow, then I have um, lenders that will give you money just because you have a cash flow. Your credit don't even matter. They just want to see deposits every month, and they're gonna go into your bank to see how you manage your bank. Okay, and that's it. And they qualify you. But the main thing is how much a business is depositing every month. Okay. It helps to show not only trends but also responsible money management. It's also another way of showing seasonality. The power of knowing your numbers. The power of knowing your numbers is vital to running any profitable business. You can make any necessary adjustments to show a profit. Numbers do not lie. They tell everything about the health of a business. Knowing your numbers means you have a huge advantage over business owners who do not. Your profit and loss statement tells a story of your unique business. Understanding the story behind the numbers can be an extremely important factor for achieving success. That means you're showing them that I know what's going on with my business, right? Lenders will often want to see your FICO score. This is particularly the case for sole proprietorships and startup companies. They want to know if you're experienced in paying back loans. And if you default on your obligations, time and business information. Um, for online lenders in particular, time and business matters. Of course, a startup has no time in business, but other ventures do because so many businesses fail in their first year. Okay. So basically, in general, once a business gets to 3 years, then they're more fundable. Okay. I've seen like when you're building business credit, the good revolving accounts like Home Depot, Lowe's, stuff like that, Office Depot, those type of accounts, they won't even give your business a credit card until they are 3 years old. So time in business is important. Okay. It affects your fundability and how fundable your business is. Okay. Means of securing the loan. Lenders are often looking for means of securing the loan. This protects them in case you default on your obligations. Fortunately, collateral and other means of securing loans can be done creatively. Okay. So we have different collateral based loans, right? Use your assets as collateral. Rates are usually low low as hell. For collateral based funding, because they know to get the money back if you don't pay. Your personal credit training will not matter, right? Some of the types of collateral you can use is 401ks or stocks and bonds. If you have those type of investments, you can use that to get a business loan, right? Inventory, if you got inventory, accounts receivable. So I have a few businesses that use accounts receivable. Like accounts receivable is also known as factoring, right? So I got a client that's a freight company. They use factoring to fund their business. Meaning what they do is they got a truck and the truck's gonna make a delivery and they invoice for the delivery, right? It might take them 30 days to get that money. But with factoring, they get their money in 24 hours. Okay? So there's different ways, right? There's also, let me go over another one. There's funding for um businesses that have government contracts, right? You can't go to the commercial bank with a government contract and ask for a loan. But there are alternative lenders that look at that government contract and be like, "Yo, um, we know that check's going to clear." So this business presents themselves like, "Hey, I got this government contract. I just need this piece of equipment. Can y'all fund this piece of equipment?" And then the check's going to start coming, right? So there are lenders like that, alternative funding, all right? Um, or ask a friend or family member with these type of assets. They may let you leverage their asset in exchange for a percent of your business. They usually want less of a percent of your company than a VC would. Essentially, they would be acting like an angel investor. It's a bonus if they can mentor you in the business. 401k financing for existing 401k or IRA as collateral for business financing. Pay no tax penalties. You still earn interest on your 401k. The rates are low as 5%. Close and fund in 3 weeks, right? So what a 401k is, you're at your job working, and they taking piece of your money that you're earning, and they give it to the 401k, which is giving it to different companies to use your money to make money. So it's a good idea to consider the funds that you earn to help you with building up and growing your own business. You can usually get up to 100% of what's rollable within your 401k. Securities based financing. Use your existing stocks as leverage to get business financing. Borrow as much as 90% of the value of your stocks. You keep earning interest on the stocks pledged as collateral. Closing and funding takes less than 3 weeks. 70-90% loan to value. Rates are like mortgage rates. 5% is common. So on all of these collateral based financing, the interest is going to be low because they know they can get their money back. It's less of a risk to them, okay? But you only pay interest on what you borrow. This is a working capital line of credit, okay? Inventory financing. Use your existing inventory as collateral for business financing. You will need inventory valued at 500,000 or more. You can get approved for a line of credit for 50% of inventory value. Usually rates are 5 to 15% depending on the type of inventory. Funding within 3 or less weeks. Okay. Maximum inventory loan amount is 150,000. General loan to value is 50%. So inventory value needs to be 300,000 or more. It can't be lumped together inventory like office equipment. Okay. Accounts receivable financing. Use your outstanding accounts receivables for financing. Get as much as 80% of your receivables advanced. We talked about this a little bit, right, with the freight company. Advanced, ongoing in less than 24 hours. Remainder of the accounts receivable is released once the invoice is paid in full. Closing takes about 2 weeks to get that process going. Factor rates are as low as 1.33%. That's low, right? Because they know they got a direct collections deal going, right? um, it is a credit line with rates as less as 1% with no consumer credit requirement. Okay? Don't need credit. Um, Receivables should be with the government or another business. If you also have purchase orders, you can get financing to have those filled. Okay? You won't need to use your cash flow to do so. Okay, accounts receivable financing, get forwarded up to 80% of receivables. You have to be in business for 1 year. These must be receivables from another business. Okay, low rates on that too. Other collateral items. Other collateral options include your company's equipment. You can also use invoice factoring. Invoice factoring is not quite of a loan. Okay. Instead, you essentially sell your outstanding invoices to a factoring company. Right? That's what I was talking about, right? The factoring. And they collect directly from your customers in that instant. Personal guarantees. Another option is the personal guarantee. It's exactly what it sounds like. Your personal assets are at stake. But sometimes, particularly for startups, you'll have to give one. Microloans. Microloans are another option. You can't get a microlave from a regular lender. Instead, you get a microloan from a microlender. Okay? Try the Association for um, E- Enterprise Opportunity to find a local micro lender. Association for Enterprise. Okay. Oh, they got a website here, microenterpriseworks.org for a micro lender. SBA loans are another option. You usually need to show some time in business for SBA loans. The most popular SBA loan for working capital is the 7A. Approvals for up to 5 million. Rates are usually 2 to 4%. Um, all owners with more than 20% ownership must provide a personal guarantee. Okay? That's so the SBA, their requirements are stringent, right? They need everything, right? Good customer report credit is required. Consumer credit and business credit is required for SBA loans. Okay. Recap before we get out of here for for what lenders look at to approve you for financing. Lenders want to be sure a company can pay back its obligations. They want to know your business is a going concern. Because they get duped a lot of times, right, with businesses. So they're gonna be scrutinizing, right? They want to see if it is succeeding or if it should be. Borrowers need to prove their credit worthiness. Documentation is crucial. Virtually every lender wants to see a business plan. Business plans can be traditional for startups, and these have different sections. Lenders also want a P&L and a balance sheet. They usually also want some sort of collateral or personal guarantee. Okay? And I got a lot of information on my social media. The best place to go is my blog, which is called "The Business Credit is Real." You can locate that at businesscreditbuilder.us/blog. Um, and check out my upcoming, wow, check out my upcoming webinars on how to build business credit. All right. Make sure you get that free guide on how to build business credit. Miss Wood, I mean, Barbie, you said to call you. You have any questions?
I do not. Thank you so much.
All right. I hope to see you in the business credit building webinars in the future. Okay.
Will do. Thanks, man.
Have a good day.
You too. Take care.
Hmm? Let me see how to get out of here.